is a well-known fact that the large majority of traders who come into the market end up losing money, while a small percentage of traders end up making a lot of money and becoming consistently profitable. If you ever wondered what set them apart, it is not just the strategies, it is not just the technical analysis, but it is also their psychological makeup as well. All three of these things are important, but the psychology aspect is crucial. And in this video, we're going to be diving into 5 psychological principles of the top 1%. If you are tired of being amongst the traders who are losing money constantly, and you want to be a part of the few who actually make money consistently, these principles are ones you cannot ignore. They're principles that you're going to have to, live by, and you're going to have to implement in your overall trading. I have been trading the markets for the last 9 years, and during this process, I've worked with 2 trader psychologists, so I understand the importance of psychology more than you know it, because I too was tired of being amongst the 95% of traders who were losing money consistently, and I wanted to be a part of the few who made profits consistently. And in trying to make that leap, I learned certain principles, and I'm sharing these principles with you today. Let's dive into it. The very first psychological principle of the top 1% is self-assurance. Ladies and gentlemen, in order for you to build a strong building, you need to build a strong foundation first. And self-assurance is the foundation to a trader's psychological makeup. In trading, there is a lot of decision-making process, right? You're going to have to make the decisions, whether you get in the trade, whether you get out of the trade. That requires confidence in yourself. There's no one that's going to be walking you through that decision. So self-assurance comes into play by you believing in your ability to succeed. You're confident in what you're doing in yourself, and you may not even have the necessary information you need yet to succeed, but at the core, you believe that you can actually do this, right? You can succeed, and you know what you're doing. And over a period of time, you're going to learn and acquire new information that may tell you, well, you were doing it completely wrong. But during that process, there's a certain level of belief in yourself and your capabilities. Self-assurance doesn't necessarily mean that you are not going to make mistakes. It is quite the opposite. Self-assurance means that you will learn from your mistake because you're going to use it to take yourself to the next level. Every win, every loss you take in trading, you're going to use it as feedback to get to where you want to get to. Self-assurance is essentially you seeing the vision before it manifests, believing that I can become a millionaire trader, I can be a 6-figure trader, I can quit my job and trade full-time before you see any signs of that. That's what self-assurance is. Self-assurance is confidence in yourself and your abilities. And ladies and gentlemen, if you don't have self-assurance, there are a couple of ways for you to develop it. One, it is through practice, right? Practice and experience by learning the necessary things you need to and gathering information, whether it's mentorship or something along those lines. What you will find is gradually, you start to build more confidence in yourself and in your decision-making process. Principle number 2 is to focus on the process and not the outcome. Focusing on the outcome is the basis to a lot of fear and doubt for struggling traders. And this is one of the things that the top 1% of traders realize is in order to make it, you can't control whether you win or you lose. In trading, we live in a land of uncertainty, and probability is our best friend. So when you come to the market, you're constantly dealing with the probability of you making it, right? Whether you are going to get a trade move in your favor or whether the trade is going to move against you. There's a probability for each of those, right? And that's what you are focusing on, right? You can't focus on whether you essentially make money or whether you lose money. One of the advice that I always give traders is to grade yourself based on your execution, not actually whether the trade wins or lose. So when you come into the market, you have to understand that this principle is used by the top 1%. And if you are going to become the top 1%, you have to detach from the outcome and start to focus on the process, focus on the execution, the steps leading to the point where you actually put the trade in and let the market do its thing. What are some of the things that you can do from a process standpoint? It could be showing up consistently in the market, giving the market a high degree of consistency, making sure that you're not coming into the market at random times of the day, because if you're coming into the market at random times of the day, you will get random results. So in order for you to get consistency, you must have a consistent process that you consistently follow. Whether you're looking at the same pair, whether you're trading the exact same strategy day in and day out, but these are the process. And once you execute, you let the market essentially do its thing. That's what you focus on. This is how the top 1% 1% of traders trade. They don't focus on whether they win or they lose. They simply focus on executing the trade. The third principle is to embrace and acknowledge the performance stress of trading. A common mistake I see a lot of new traders making is that they ignore the fact that trading is performance based, right? Nobody wants to talk about the fact that trading is extremely stressful. And when you are not paying attention to the fact that trading is performance based and there is a performance stress that comes with it, you are also not paying attention to the fact that you have to prepare for this aspect of trading. It's kind of like having a formidable opponent in front of you and just completely disregarding that opponent, knowing that the opponent is going to attack you, regardless of whether you choose to ignore it or not. That's essentially what it is. So for a lot of traders, they just like, okay, I'm just going to trade. I'm not going to think about, the performance aspect of it. I'm just going to deal with it when it comes, right? And that's how a lot of traders end up becoming reactive, and they start to overreact when the market does certain things, whether they take a loss or anything like that, because you didn't prepare for that. The top 1% of traders understand that this principle is crucial in order for them to consistently make money day in and day out. And this is something that I realized in my own trading journey as well. And I said, you know what? I got to go get a psychologist, and I need to work and I need to learn how to manage myself from an emotional standpoint. And some of the things I just learned during that process is trading is very performance based, right? Whether you win or you lose, which is what we talked about, focusing on the process, not the outcome in the beginning, is important because that's all you can focus on, right? So when you focus on the fact that, hey, trading is stressful, you want to put yourself in a mental state where you can handle the stress regardless of what the market throws at you. And the very first step is to understand what happens when you come into the market. The very first thing is when you come to the market as a trader, whether a beginner trader or a seasoned trader, and you put capital at risk, your amygdala, which is part of your limbic system, can be triggered at any point in time, depending on, what is happening. Maybe you're about to take a loss, for example. Your amygdala will process this as a fearful situation because that's its job, and you're going to go into a fight or flight mode, and that could look like you engaging the market, right, and fighting the market and taking multiple trades, not following your plan, and overall just blowing your entire account. So it is important that you keep your amygdala in check, and one of the best ways that you can do that is by focusing on your breathing, using breath work to essentially calm yourself. But the main thing is you can use a biofeedback, which is a heart rate monitor, right? A biofeedback is a device that gives you real-time data on how you are feeling, and a heart rate monitor is great to do that. So one of the things that I do when I trade, I will wear a heart rate monitor. That heart rate monitor will give me real time, like, okay, what's my heart rate? Because I know when my heart rate increases to 90 beats per minute, when my resting heart rate is 65, I know I am getting to a point where I am likely going to get triggered, from psychological standpoint, and I will start to make, my amygdala will get hacked. It is important to put yourself in a position where you understand the risk of ignoring the performance stress, and you prepare for that by meditating, using a biofeedback device, and just overall respecting that trading has to do with a lot of performance and doing the best that you possibly can to make sure that you are in the optimal state to consistently perform in the market. Knowing others is intelligence. Knowing yourself is true wisdom. Mastering others is strength. Mastering yourself is true power. This is a quote by Lao Tzu, a Chinese philosopher. And this leads us to a fourth trading psychological principle of the top 1%, which is self-awareness. In order for you to become the best possible trader that you are going to be, you need to know your strengths and your weaknesses. And this is an advantage that you can give yourself in the market. The top 1% of traders understand that in order for them to become the best possible trader they can be, they have to know what they are good at, and they have to know what they are not good at. This is something that I even did in my trading journey. I took my journal and I said, Emmanuel, these are your strengths, right? And these are your weaknesses. And I wrote out my strengths. Okay, cool. These are my weaknesses. How can I improve them? What are some of the things that I can put in place to essentially make sure that I get better over a period of time? And this is something that you can do for yourself as well, because you need to know what are some of the things that you're doing right and some of the things that you're doing wrong. And when you have both of them side by side, you can go down your weaknesses and you can say, well, let's say I overtrade, for example, right? One of my main weaknesses is overtrading. Okay, how can I fix that? Maybe I limit the amount of pairs that I look at. And this is something I did because I was also experiencing the need to constantly be in the market because I come from a workforce. I am a worker. And so I had a worker's mentality that in order for me to become a profitable trader, I had to constantly be in the market and be doing something every single day, spending 10 hours looking at the charts, taking multiple trades. That was it, because I believed that the more time I invested, the more money I made. But then I realized that in order for me to become successful, I have to limit what I look at. Less is more. That just came from me analyzing one of my strengths and focusing and working on it. So in order for you to become successful, I would advise you to follow this principle, which is to gain self-awareness. If you have a high degree of self-awareness, that's good. You've likely already done this. But if you're a trader who haven't, analyzed your weaknesses or your strength, this is something that you can do after watching this video. It's a great exercise because each problem that you're experiencing requires one or two solutions for them to become a part of your strength. And that's what I did. I turned a lot of my weaknesses to strengths. I hated trading consolidations in the market because I always lost, and now they are one of my favorite strategies. I used to overtrade a lot. Now I only trade, a couple of times a week, even though I am a scalper. So it's like focusing on what you're good at and also being aware of what you're not good at and trying to work on that. So my advice would be to take a piece of paper, write out your strengths, write out your weaknesses, and work on that. The last trading psychology principle of the top 1% trader is an understanding that trading psychology is not the cure for a lack of edge in the market. It's a common mistake I see with a lot of traders who say trading psychology is 90% of trading. I just need to fix my psychology in order for me to be profitable. But when you actually look at your overall trading strategy, you realize they have no trade plan. They don't have a consistent edge in the market. They're trading, multiple different pairs and doing a wide variety of, different entry points every single day and hoping that if I am more patient and maybe if I'm more disciplined, then I can actually make money. That's not going to work. The very first step is to understand that trading psychology is like a fuel to your vehicle. It is not going to be the vehicle itself that takes you from point A to point B. That is going to be your edge. Trading psychology will act as the gas and the control system that is going to help you navigate the market. But the very first thing is you need to have a strategy that is already working, that at least has a high degree of consistency, whether it's 30%, 40%, or even 50% profitability, right? Because if you don't have that already, it is going to be hard to say, well, if my psychology improves, if I'm a little bit more patient and disciplined, I am just going to, start winning the market. It doesn't happen like that. And this is something I noticed even in myself, in my own trading, when I was working with my psychologist. I had to constantly improve my overall edge in the market in addition to the psychology work that I was doing, with my psychologist. And once I pinned down my entry point, how I was going to show up in the market from an execution standpoint, what I was looking for in the market, trading psychology allowed me to come into the market calm, relax, and I wait patiently for the setup that I'm looking for. And when I see the setup, boom, I strike. My psychology allows me to maintain my emotional regulation, and then my edge allows me to execute and essentially make money. And this is something that you will see if you watch my live trading session and so on and so forth. But the number one principle is to understand that psychology is an important aspect of trading, but you still need to have an edge for psychology to be effective in the market. And that's the video, traders. Thank you for watching. Hope you found it insightful. Here at LiveFree FX, our slogan is where the mind meets the market. So today I felt like it was good to bring a psychology video to you guys. Hope you found something insightful for it. If you have any questions, feel free to leave it down in the comments below, or even a takeaway from the video. As always, it's Emmanuel from LiveFree FX. I want to thank you guys for watching. Until next time, hope you're out there living free. Cheers.